Bitcoin. It's the buzzword that's everywhere, from tech blogs to investment analysts, all the way to your neighbor who claims it's the future of money. But what exactly is Bitcoin and how does it work? More importantly, why does its price seem to swing like a pendulum, sometimes skyrocketing in value, only to crash days or weeks later? Let's start at the beginning. Bitcoin is a digital currency, no bills, no coins, no banks. Instead, Bitcoin operates on a technology called blockchain. Think of blockchain as a digital ledger, a record book that keeps track of every Bitcoin transaction ever made. In theory, this scarcity contributes to its value, similar to gold. But scarcity alone doesn't explain everything. Bitcoin's value also comes from utility. It allows peer-to-peer transactions without middlemen, enabling cheaper and faster transfers, especially across borders. Additionally, it's seen by many as a hedge against inflation, akin to digital gold. Unlike traditional systems where banks or governments oversee transactions, Bitcoin's ledger is decentralized. It means the responsibility is shared across thousands of computers called nodes, all working together worldwide. Now, here's the spark of genius. Bitcoin uses cryptography to ensure that transactions are secure and can't be tampered with. At the heart of this system is something called proof of work. It's a process where computers solve incredibly complex mathematical puzzles to verify each new block of transactions on the blockchain. This is known as mining, and miners are rewarded with Bitcoin for their efforts. These rewards are how new Bitcoin is created, and it's capped at 21 million coins, making it a finite resource. In theory, this scarcity contributes to its value, similar to gold. But scarcity alone doesn't explain everything. Bitcoin's value also comes from utility. It allows peer-to-peer transactions without middlemen, enabling cheaper and faster transfers, especially across borders. Additionally, it's seen by many as a hedge against inflation, akin to digital gold. However, here's where the excitement turns to danger. Bitcoin's price is incredibly volatile. In 2017, it surged to nearly $20,000 per Bitcoin before plunging by 80% months later. Fast forward to 2021, it reached a jaw-dropping $67,000, only to face dramatic pullbacks. Why does this happen? One reason is speculation. Unlike fiat currencies backed by governments or physical economies, Bitcoin's market is heavily influenced by investor sentiment. Traders buy and sell based on social media trends, news headlines, or fear of regulation. There's also scarcity. When demand spikes, there simply aren't enough coins to go around, driving the price up sharply. But perhaps the biggest factor is the lack of stability. Bitcoin isn't widely adopted as a true national currency or standardized store of value. Without consistent utility, its price is at the mercy of those who see it as an opportunity rather than a necessity. This volatility makes it risky not only for investors, but also for businesses that might consider accepting Bitcoin. So, can Bitcoin ever overcome these swings? Advocates hope mass adoption or regulatory clarity will stabilize its place in the financial system. But skeptics wonder if Bitcoin's wild ride is more feature than flaw, a constant reminder of the tension between decentralization and predictability. Bitcoin is bold, it's revolutionary, but is it ready for the world? Only time will tell.